Investing can feel like a minefield. How do I time the market? Could I lose all of my money? Well, we're going to answer those important questions. In this video, we're going to break down all of the key investing strategies, what they are, and whether they may or may not work for you. By the end of this video, you'll have a key understanding of all of those strategies, and I'll also talk you through the strategy that I use for investing my money, so that you have all the information to make the best decision for you and where you place your money for the future. Sound good? Let's get into it. Hello and welcome back to the channel. My name is Lewis and here we talk about everything to do with personal finance, growing your money and finance education. And in this video today, we're going to be specifically talking about investment strategies and helping you work out what might be the best investment strategy for you and your money. Investing can feel like an overwhelming topic. There's so much information out there coming from all sorts of different sources. So hopefully this video will help simplify some of that information for you so that you can make the best decision for you. The truth is, successful investors aren't smarter than you. All they do is stick to a specific strategy. So that's why we're going to go through this to help you pick the strategy that is right for you. We'll also talk about some of the risk levels associated to each strategy, which ones might work for you, which risk levels you're happy with, and how the risk scales depending on the strategy that you pick. And we'll also provide some companies as examples of companies you might invest in if you choose a specific investing strategy. So that kind of covers everything that we'll go through, and then I'd say at the end I'll go through what investing strategy I choose and how I utilize that to grow my money. But without further ado, now we'll go into strategy one and we'll get started. The first investing strategy is value investing. Value investing is effectively finding a company that you want to invest your money into that is undervalued compared to what you think it should be in the market. It might be undervalued for various reasons due to its earnings, the amount of cash flow it has, or a variety of other things might cause it to be worth less in the market than you think and others might think it will be worth in the future. So value investing is picking out those companies and putting your money into those, buying stocks, buying shares of those companies before you think they're about to grow and they're about to correct in the market to be of a value that is more in line with some of the earnings and profitability numbers that they're producing. So that's a snapshot of value investing. It doesn't tend to be the most risky investment strategy. We're certainly going to talk about some more in this video that are slightly more risky than value investing. However, you do need to be really confident in knowing that you think that company is going to improve in value in the short term to want to be able to put your money into that company. It's probably a category that's used maybe a little bit more by experienced investors who have a lot of pricing history and information available about companies to know whether those companies are likely to bounce back to a more conventional worth. Their share price is likely to jump back to something more in line with what it's been previously in the short to mid term. If it's not something that you feel like you have a handle on, you don't want to throw yourself into the financial charts and kind of working out an average rate of kind of stock and share price of a company, this one probably won't be for you because it requires a lot of time, it requires a lot of financial acumen and knowledge, and it requires you to be able to break share price down as a representation of other financial metrics within a business. So it can be really profitable if you pick out a company that is certainly undervalued and corrects itself in the market. You can make lots of money in a real short space of time. However, you really need to know the key metrics and what you're looking for to be able to do that. If you get it right, you can make lots of money, and it tends to be a lower risk strategy because the companies that you're buying into tend to be larger established companies that are just underpriced compared to the market. You're not going after companies that are new, they've just recently listed on stock exchange. You're not going after those types of companies because they could fall into other strategies that we'll cover. But for this strategy, you're going after probably established companies that are slightly undervalued. Good examples of this, both across the UK and the US, would probably be a lot of banks would fall into this category because in financial downturns, economic crises, crash, anything that happens in the market, banks tend to be one of those companies whose share prices can retreat quite quickly, but over time tend to grow back to a sort of steady baseline level and value. It's important at this stage that I add that nothing in this video is financial advice. This is just me offering kind of explanations of certain strategies and opinions on what I think the strategies mean and what companies might fall into the various different strategies. Nothing in here is financial advice, so please don't go away from this video and decide that because I've said this, you're going to invest in these specific companies that are mentioned in the videos. They're just examples. Make sure you do your own research, you work out which companies are right for you, and of course, if you invest your money, then your money is always at risk and can go up as well as going down. The next strategy is growth investing, which is kind of the opposite to value investing that we were just discussing in the previous section. Growth investing is where you seek to find companies and invest your money into companies that you believe will outperform the market average. So market average, if you were to invest your money into a regular fund that has a basket of companies in it and that's used as your benchmark for how much you think the market will grow, if you're going to go and invest in growth companies, you expect their growth to outperform the money that you would have put into that fund. So that's the difference there, and that's how you define a company or an investment strategy by being a growth investment strategy. These can be really high risk strategies because there's no guarantee that the industry that your chosen company operates in is going to boom and is going to outperform the rest of the market. A great example of this recently of growth investment companies and a growth investment strategy is the AI boom that we currently find ourselves going through and have been in for a few years now. Lots of companies like Google or Alphabet, I should say, the Meta platforms, Nvidia, Amazon, lots of companies, the big tech companies that operate in that sphere have seen massive growth recently in their share price and over the last few years due to their investments and growth of the AI market. And those companies have been a big part of that. So if you'd have invested your money and you'd have seen the AI boom coming or been an early adopter of the AI technology, you will have thought to put your money into those companies a few years ago. And over the course of the last few years, you'll have seen your money grow exponentially as those companies really surge forward. That's a great example of a growth investment market and a growth investment strategy. So those are the sorts of things you need to be looking for. But as I say, it can be high risk because there is no guarantee that the market that your company is in will actually boom. And secondly, there's no guarantee that the company that you choose will be the company that booms in that industry. So there's a couple of risks associated there. You tend to find the hallmarks of growth companies are the companies that are significantly reinvesting their profits back into the business. So they're not necessarily paying out big dividends or anything like that. Their money is going back into reinvesting into growing the company further. There's lots of investment in new technology, in ways to help make processes easier and quicker. So there are a few hallmarks of things that you can look for in companies to identify whether they might be part of a growth market and if that's something that you might want to put your money towards. It's important to remember that you also need to believe not just in the company but in the industry. If you just believe in the company, it's a really good company, but in a sector that's falling away, then over time it's unlikely that the company that you've invested in is going to grow. Whereas actually you need to believe that this company is a company that I think is going to grow, and also this industry is an industry I believe is going to grow. And that's why the AI bubble, the AI boom, is a great example of a growth strategy. What sort of person are you? If the growth strategy is right for you, or growth investing is right for you, well, you're someone that can tolerate volatility in the market, so you can be comfortable with the fact that your investments might grow lots and they also might shrink lots. If you're someone that's not necessarily worried about looking at your investment value every single day, then maybe growth investing strategy is the right strategy for you. If you're after long-term gains, then this is also potentially a good strategy for you, although a couple of other strategies are also good for that we'll touch upon. But by and large, if you think you're in a good industry and you've got a good company, growth investing is a great strategy for you. And the main thing is that you're not someone that's going to panic if the market drops. So if the market drops away, you're not going to be straight in there selling off your investments, because all you're going to do in that instant is compound your losses. And obviously that's not what we want, particularly if we're going for a growth investing strategy. We want to see that number increasing. The third strategy we're going to talk about is income investing. Income investing is a little bit different to the two strategies that we've discussed previously, and tends to be preferred by people that are after a little bit more and looking for a little bit more stability and sacrificing that perhaps growth and fluctuation that you see from the previous two strategies in exchange for a little bit more cash flow. The cash flow comes from the companies that you're invested in paying out dividends, and dividends are a portion of the company's profits that are paid to shareholders of that company. If you hold one share in a particular company, that company pays out dividend payments, you will get whatever that percentage you own of the entire company, you will get as the percentage of the dividend payment that the company that you own makes. So if you own one share of a company, it could be as little as 20 or 30 pence. But if you own hundreds or thousands of shares of a company, you can see how that would multiply up quite significantly to be a dividend payment of a few hundred or a few £1,000s. That's what income investors are seeking to achieve. They are seeking to pull together a collection of companies that pay out consistently in terms of dividends, so they don't withhold their dividends perhaps for investing in new technologies and things like that. So they pay out consistently in their dividends, and then they reinvest those dividends back into the companies that they own to help multiply the amount of shares that they own, which means they get paid more dividends, and so the cycle goes round. So that's the aim of an income investor. As I mentioned at the start, it tends to be a little bit lower risk than some of the other strategies. So I'd probably put this one at the lowest risk end of the scale of strategies we're going to talk about, because you tend to be going for more stable companies that have existed for a long time, consistently made money, consistently paid out dividend payments. Their share price may not jump by 10 or 15% each year, which you might get from the value investing or the growth investing, but it might still continue to grow by 4 or 5% each year, but you're also getting paid out a dividend payment that helps top up that money and replaces some of the growth that you might have missed out on. You often find that in these strategies you're not quite making as much money as the other strategies, but in the other strategies you have to assume that it goes well. So that's really the catch, and that's why a lot of people do choose income investing as their chosen strategy. Good companies in this area: Coca-Cola is probably one of the most iconic ones. Visa's a really good one, a company that I invest in for dividend payments through Visa. AT&T in America, Unilever in the UK. There are a few good companies out there that you might not see massive share price growth each year, but you do see continual dividend payments and those dividends growing. The dividend growth rate is something that's really important to look at if you're considering investing into companies that pay out dividends and you're looking to income invest. Who is income investing for? Well, it's a popular strategy with people that are retired or coming close to retirement because, as I say, the companies involved tend to be less volatile in their share price. So all the money that you've accumulated for your retirement tends to hold, and then you're building your income through the cash flow, the dividend payments that you've got coming in. They're also suitable for conservative investors, people that don't like taking a lot of risk, no matter what age you are, if risk is not something that you want as part of your portfolio, and really just anyone that's looking for some cash flow, because you don't have to reinvest your dividends if you don't want to. You could bring those and take those dividends out as a payment. The companies that you owe are paying you. You could take that money out and put it towards another area of your life if you wanted to, that suits you. I wouldn't recommend doing this because for an income growth portfolio to work really well, reinvesting the dividends back into the companies you own is going to be the best way of growing your money. If you're enjoying these investment strategies, or maybe you've even heard the strategy that already works for you and you want to hear more content about investing in the future, then make sure you subscribe to the channel, because I'm going to be producing a load more content like this that breaks down investing, also breaks down how to save for retirement, how to build an emergency fund, how to add extra income streams through side hustles, things like that. So if that sounds like something you want to hear more about, then make sure you subscribe to the channel. But let's get on to the next strategy. The next strategy we're going to look at is index fund investing. Index fund investing is very different to all the other strategies that we've discussed previously, and focuses on investing in funds where the money goes into multiple companies all in one. So see it as like a basket of goods, and in that basket, which is you're investing in that basket, and in that basket is lots of different items, lots of different companies. So instead, when you put your money into an index fund, you're actually investing in a small piece of that money into all of the companies in that fund. So if you were to, let's probably take one of the most obvious ones, if you were to take £100 of your money and you were to put it into the S&P 500, an index fund tracking the S&P 500, then all of that money that you put in, that £100, will be split up across all of the companies in the S&P 500 based on the percentage of that fund they make up. So some of the big companies like Google, Amazon, etc., right at the top end, they'll take up a bigger percentages, and then there'll be companies that maybe are only just creeping into the S&P 500, and so their value makes up a much smaller amount of what the S&P 500 is worth, so therefore less of your money goes into those. So that's how index fund investing works. The key here is picking a fund that works for you and picking a fund that works with your strategy. So it might be that you want to focus on the American markets. So the S&P 500 or the NASDAQ is a great choice of fund to invest in. Or it could be that you want global reach. You want the biggest companies all across the world, in which case you can look for a global fund, which are provided by companies like Vanguard, really easy to find, and you can pick them on apps like Trading 212. You can just pick a global index fund and invest your money into that, and it will be split the same way as the way I described before. Index fund investing grants you diversification. It means that your money is split across all of those different companies, which means that if one company has a bad set of financial results or has a bad period, your money is still largely protected across all of the other companies that you're invested in, which means it can remove some of the volatility created by individual companies. I should caveat that by saying that if a sector or an industry doesn't perform very well, that can have a slightly bigger impact on your money and how your money performs and grows. So for example, there's a lot of big tech companies at the top of the S&P 500 at the moment, the NASDAQ at the moment. If those companies were to underperform, they were to have a bad run, the AI bubble may pop or something like that, and they were to perform badly, that would have a bigger impact on your money than if just one of those companies struggled. So that's the kind of pros and cons of fund investing. But in general, fund investing gives you better coverage and shields you from more imminent and impactful market crashes that could come into effect. So that's really what fund investing is for. It's sort of a low to medium term risk. You do still carry some risk, and that risk probably has grown over the years because of what I mentioned before about some of the big tech companies making up a large part of funds like the S&P 500. But in general, it tends to be lower risk than picking individual companies because you've got a good broad range of diversification across different industries and different companies by picking the fund. As I mentioned, if you were to pick the S&P 500 as your fund, you would see your money going into Apple's, Amazon's, Nvidia, Meta platforms, those types of companies. If you were to pick the FTSE 100, which is a fund in the UK, the 100 biggest companies in the UK, you'd see your money going into HSBCs or Shells or BPs, things like that. So that's how it works, and those companies make up the full value of the fund. Who is index fund investing for? Everyone is my answer to that question, because no matter who you are, no matter what you do, there's a likelihood that an index fund forms part of your overall investing portfolio or strategy. If you're someone that's chasing growth investments, one of the strategies we mentioned previously, you're likely to want to give yourself still a base that you've got invested that your money can fall back to. So the likelihood is you've probably invested some money into a fund, and you've got that, whether that be 10% of your money, 80% of your money, any percentage, the likelihood is that you've got some of it in a fund to give you a base that if your growth investing strategy doesn't pay off, you've still got some money invested and growing across a wider range of companies. It's also really good for people that are starting out. So if you're new to investing and you don't want to spend the time diving into companies and finding out about their balance sheets and their cash flow and all of these things, which understandably you might not want to do, then by investing in a fund, you just get access to all of these companies without having to do that research. So from beginner to experienced pro investing, funds really do form part of your investing plan along the way, no matter where you are. So that's why fund investing, and I mentioned I would talk about my strategy, index fund investing is the strategy that I choose for my money, because it gives me that wide range of access to all of these companies that, I'll be honest, I don't have the time to sit down and spend researching all of the different financial metrics used to work out how well a company is performing. Instead, I can just provide my money to this fund and it is split across all of these companies. So I have access to all of them. If they were to grow or if they were to shrink, I have got access across the market. And that would always be my chosen strategy. I have a couple of companies that I sort of pick out more along the income investing strategy line. So I've mentioned before, Visa, JP Morgan, Home Depot as a few companies that I have in my portfolio, my investing portfolio that I've picked. That's mainly because they pay consistent growing dividends, and I like to just have them as a bit of a anchor in my portfolio. But less than 5% of my money is invested in those companies. Everything else is invested in funds. That includes my pension as well as my stocks and shares ISA that I have with Trading 212. So that's the chosen strategy for me, because I think it provides the best opportunity to reach your financial goals in the future without having to factor in massive losses and massive gains along the way. It provides you an easier to understand path to get from where you are now to where you want to get to. And that's it. Those are some of the key investing strategies that you could use to help decide what you want to do with your money. Hopefully in today's video you've been able to see what those different strategies are, what type of person you might be to decide to take that strategy on, and the things to look out for when investing in choosing those strategies for your investments. As I say, there is no right or wrong answers to which strategy is right and which strategy is wrong. They all yield different results, but the important thing is that you choose the strategy that best aligns with what you want to do with your money for the future. So if you really want to chase those big wins and you don't care if your money goes up and down, go after that growth investing strategy. Spend the time, do the research, pick the companies that you think have got the best potential in the future. At the same time, if you just want to set and forget and walk away and check in on your money once every couple of months, once a year even, pick fund investing, pick index fund investing, because that's what's going to best suit what you want to do. And it means that you can passively invest. You don't miss out on key market gains and market opportunities without having to sit there and pick the individual companies that you think are going to perform the best. Hopefully you found those investing strategies really useful and you're going to use those in your day-to-day life going forward for your investments. But other than that, thank you very much for watching, and I look forward to seeing you in the next video.